Did you know that less than 5% of all investors consistently outperform the market over a 20-year period? This remarkable fact raises a fascinating question. What sets these elite investors apart from the overwhelming majority? Imagine sitting down for dinner with Warren Buffett, Ray Dalio, and Peter Lynch, three giants of the investment world who have collectively built fortunes exceeding $120 billion. What advice would they give you? What timeless principles have enabled their extraordinary success? The journey begins with a surprising realization. The world's most successful investors don't follow complicated strategies accessible only to financial geniuses. Instead, they apply simple but profound principles, with exceptional discipline and remarkable consistency. Warren Buffett, the Oracle of Omaha, began his investment career with just $114 at age 11. Today, his fortune exceeds $100 billion. His most important lesson? The stock market is designed to transfer money from the active to the patient. This wisdom stands in stark contrast to our fast-paced, instant gratification culture. Have you ever wondered why so many smart people fail at investing? The answer lies not in a lack of intelligence, but in emotional discipline. As Howard Marks, co-founder of Oaktree Capital Management, emphasizes, successful investing has less to do with analyzing numbers and more to do with mastering your emotions. Think back to March 2020, when markets crashed due to the pandemic. While millions of investors panic sold, the masters saw a historic buying opportunity. This contrarian mindset, the ability to swim against the current, is a recurring theme among elite investors. Could you act against your instincts when everyone around you is panicking? Compound interest is often referred to as the eighth wonder of the world. Einstein is said to have remarked, "Those who understand it, earn it. Those who don't, pay it." This principle explains why Buffett accumulated more than 99% of his wealth after his 50th birthday. It's not just the annual return that counts, it's the time those returns have to generate their own returns. Consider the numbers. $10,000 growing at 10% annually becomes $25,937 in 10 years. Extend that period to 30 years, and you'll have $174,494 without adding a single cent. This mathematical magic explains why starting early and staying invested long-term is more important than trying to time the market perfectly. Peter Lynch, the legendary manager of the Fidelity Magellan Fund, achieved an average annual return of 29.2%, one of the best investment track records of all time. His philosophy? Invest in what you know. This down-to-earth approach contradicts the widespread belief that successful investing requires complex financial models or insider knowledge. Look around your own life. Which products and services excite you? Which stores are always full while others are empty? Lynch discovered that ordinary investors often have valuable insights into consumer trends before Wall Street notices them. This information edge can be a powerful advantage if you know how to use it. The risk management revolution. George Soros, famous for breaking the Bank of England, attributes his success not to aggressive bets, but to his ability to quickly recognize and limit losses. It's not whether you're right or wrong that's important, he says, but how much money you make when you're right and how much you lose when you're wrong. This surprising focus on risk rather than return is a recurring theme in the philosophies of the most successful investors. Ray Dalio, who started with $3,000 and built Bridgewater Associates, which now manages over $150 billion, emphasizes, never bet too much on any one thing. Life has a way of overturning even the most carefully laid plans. What about your own risk management? Do you have a clear strategy for handling a sudden market downturn? The masters know the question isn't whether market corrections will come, but when, and they prepare mentally and financially for them. Charlie Munger, Buffett's longtime partner, stresses the importance of continuous learning, stating, "In my whole life, I have known no wise people who didn't read all the time." The most successful investors are voracious readers, constantly updating their knowledge and challenging their assumptions. They understand that markets evolve, while human nature, driven by fear and greed, remains constant. Munger's multidisciplinary approach, which integrates insights from psychology, history, mathematics, and numerous other fields, allows him to analyze investment opportunities from multiple perspectives. This mental model framework avoids the narrow specialization that often leads to poor decisions. How diverse are the knowledge sources that influence your investment decisions? John Templeton, a pioneer of global investing, demonstrated the value of looking beyond domestic markets long before international investing became mainstream. His famous strategy of buying at points of maximum pessimism led him to purchase stocks of European companies during the darkest days of World War II, a move that seemed foolish to many but resulted in extraordinary returns. Imagine having the courage to invest when everyone else is panic selling. Templeton's willingness to go where others feared, both geographically and psychologically, offers a powerful lesson in contrarian thinking and global perspective. Have you ever considered how global diversification could improve the resilience and growth potential of your portfolio? Seth Klarman, often referred to as the Oracle of Boston, built his legendary status through an unwavering focus on value and risk management. Unlike many investors chasing performance, Klarman is unafraid to hold cash, sometimes in large amounts, when no attractive opportunities are available. His patience during market euphoria may seem boring, but his willingness to deploy capital during downturns has delivered exceptional returns for his Billpost Group. The greatest challenge for investors is not selecting securities, but selecting themselves, he notes, emphasizing that understanding one's temperament is crucial for investment success. Are you investing in a way that aligns with your personality? Or are you forcing yourself into strategies that cause psychological stress? The power of simplicity. Consider the wisdom of Jack Bogle, founder of Vanguard, who democratized investing through low-cost index funds. Don't look for the needle in the haystack, just buy the haystack, he advised, recognizing that most active managers fail to outperform the market after fees. Bogle's approach requires no extraordinary skills or emotional fortitude, just the discipline to invest consistently in broad market indices. The practical lessons we can learn from these masters are clear, even if they're not easy to implement. Develop a long-term perspective. Think in decades, not days. Focus on understanding what you're investing in rather than chasing trends. Manage risk through diversification and appropriate position sizes. Cultivate emotional discipline to act rationally during extreme market conditions. Never stop learning and challenging your assumptions. These principles may seem simple, but applying them requires constant vigilance against our own psychological biases. Recency bias leads us to overemphasize recent events. Availability bias directs our attention to dramatic but potentially irrelevant information. And confirmation bias encourages us to seek only evidence that supports our existing views. The masters succeeded not because they lacked these biases, but because they developed systems to counteract them. What can you do today to integrate these timeless lessons into your own investment strategy? Start by evaluating your approach against these principles. Are you investing with Buffett's patience, Lynch's analytical rigor, or Soros's risk awareness? Are you globally diversified like Templeton? Do you have the discipline to hold cash like Klarman when necessary? Or does Bogle's passive approach better suit your temperament? Consider creating an investment policy statement that articulates your goals, time horizon, risk tolerance, and investment philosophy. This document, which is reviewed regularly but rarely changed, can serve as an emotional anchor during turbulent market periods. Many investment mistakes arise from reactive decisions made in moments of market stress. A well-crafted policy can help you stay focused on your long-term plan rather than short-term market noise. The path to investment success is clear, though not easy. It requires patience, discipline, continuous learning, and emotional control. But as these legendary investors have shown, the rewards for following these principles can be extraordinary. Every journey begins with a single step. Perhaps yours starts with understanding these timeless lessons and applying them to your financial life today. Remember, the goal isn't to become the next Warren Buffett or Ray Dalio. Rather, it's about integrating their wisdom into an investment approach that works for your unique circumstances, goals, and temperament. The true measure of investment success isn't beating an arbitrary benchmark or outperforming a neighbor, but achieving the financial future you envision for yourself and those you care about. With the lessons of these investment masters as your guide, that future might be closer than you think. Will you join the few who learn from their wisdom and achieve lasting investment success?